Okay, so these videos are going to focus on the midterm review. So you could treat this as a quick crash course. I'm going to focus on the major topics that are going to be tested on the midterm, but that doesn't mean I'm going to focus on every topic. A few chapters I'm going to skip out, like chapter 1. I'm going to do some of chapter 2. My main focus is going to be on chapters 3, 4, and 5 because these questions are for sure going to be on the midterm. And the similar type of style of questions will be on the midterm. There's a really good chance that could happen. However, keep in mind that this is all at the professor's discretion. So these set of videos does not give you guys an excuse to miss out on chapters 1 to 5 tutorials. So I highly suggest you guys still go through this. Still go through those and then come to these videos and test yourself. And this is your last source of questions, your last set of questions before you actually tackle the midterm. So let's dive right into it. The first question we're going to tackle is from chapter 5, merchandising. You run a wholesale business for the specific company, selling inventory to small retail stores. During the month of July 2021, you have the following transactions. Record each of the transactions into the expanding accounting equation using account names. The chart has been provided for you. Answer the questions after completing the chart. So we're going to answer all of these questions into this chart over here, and we're going to fill in the account names as we go. You should attempt the chart before completing these questions. You don't have to print it out, and you may have more lines than you need. Account names are given and totals have been provided so you can check your work. This will not be the case on the exam. So since it will not be the case on the exam, I took out the account names and the totals. So we're going to do it from scratch. And then afterwards, we're going to tackle these questions. So we have opening balances. So the first one we have is going to be cash. So let's set that up. The opening balance for cash is going to be 7289. Then we have inventory. Inventory is going to be 4260. Then we have owner's capital. And owner's capital is going to be 8,000. And then we have retained earnings, which is going to be 3549. So on July 2nd, we purchased inventory from PJG Inc. for 5,900, terms 2, 10, and 30 FOB shipping point. So whenever it comes to the merchandising transaction, the first question you want to ask yourself is, are we the seller or the buyer? In this case, since we purchased something, we are the buyer. That's very important. And next, so we're buying inventory, obviously. So let's go ahead and increase inventory for 5,900. So we're given credit terms. So either we could pay for this inventory with cash or on account. So on account means accounts payable when we are the buyer. In this case, since we're given credit terms, is going to be on account. So 5,900 accounts payable for liabilities is going to increase. Because remember, accounts payable is a future obligation, and that's the definition of a liability. Now we have the obligation of owing this money in the future. Now, when we talk about the terms, 2, 10, and 30 simply means that if we pay within 10 days, we get a 2% discount, no matter what it is due within 30 days. So 210, the 10 means 10 days, the 2 means a 2%, and means net, 30 means 30 days. So if we play by July 12th, we get a 2% discount. So the way I calculated that was I took July 2nd, added 10 days to it. That's July 12th. Okay, next we want to focus on FOB shipping point. So there's FOB shipping point and FOB destination. So this is a review from chapter 5 tutorials, but quickly to recap it. FOB shipping point means that legal title exchanges hands when the seller ships it from their warehouse at the shipping point. That means during transportation, it's in the buyer's possession. That means buyer pays for transportation. So buyer pays for transportation. Whereas FOB destination Legal title exchanges hand once it arrives at the buyer's warehouse. So during transportation is in the seller's perspective. That means that the seller pays for transportation. So in this case, on July 3rd, the appropriate party paid $130 freight on the purchase. All right, so since we're the buyer and it's FOB shipping point, we're going to pay for transportation. And so in this case, our cash is going to be reduced by 130, so negative 130 decrease. And in this case, this is the added cost of us getting the inventory. So inventory is going to increase by $130. Then on July 7th, we returned $1,000 of inventory to PJG Inc. because it was a wrong model. The return was shipped FOB shipping point. All right, so we returned products. So simply put, on July 7th, our inventory is going to be decreased or reduced because inventory is now leaving our warehouse, right? We have less inventory. Since we returned this $1,000, we don't owe this money anymore. So our future obligation or accounts payable is also going to be decreased by $1,000. And remember, FOB shipping point now. So these rules is a little bit different now because it's the flip of it, but think about it from a logical standpoint now. Remember, accounting approach it from a logical standpoint. Did we make the mistake or did the seller make the mistake? The seller shipped the wrong item, the wrong model. So it's only fair that they cover the shipping, right? So for July 8th, the appropriate party paid $95 freight on the return. Since the seller made a mistake, for us is going to be no entry. Because that's going to go under the seller's accounting cycle or the seller's chart. Then on July 9th, sold inventory to this company for $6,800 on account, terms 110 and 30. Remember, if this means that in this case, we sold inventory now, right? So we are the seller. So this means that if they pay us within 10 days, we get a 1%, they get a 1% discount, no matter what is due within 30 days. The cost of the merchandise was $4,400. Shipping terms were FOB destination. Okay, so once again, are we the seller or the buyer in this specific situation? Since we sold something, we're the seller. Simple as that. Okay, when we are the seller, it is a two-part entry. Keep this in mind. First, we have to update the revenue. Second, we have to update the expense. So let's update the revenue first. The revenue has to do with the higher amount because remember, we're going to sell these products for a profit. So we sold inventory to this company for $6,800 on account. So in this case, we didn't receive cash for it because it fully says on account. On account means accounts receivable. So in this case, on July 9th, $6,800 is going to be increased on accounts receivable. Accounts receivable is an asset because accounts receivable is a future benefit because now that customer owes us money in the future, which is the definition of an asset. Next, we're going to increase our sales revenue because remember, we sold something now. So sales revenue is going to be increased by $6,800. So we've dealt with the revenue portion. Now let's deal with the expense portion. So in this case, inventory is being reduced by $4,400. So we're going to decrease inventory by $4,400. And remember, we had to pay for this inventory to get it into our warehouse. So since this inventory is now leaving, that gives rise to an expense. So remember, an expense is a cost that we've incurred, consumed, or used up. So we've used up this expense because now we've sold it. We took it out of our warehouse. So that gives rise to an account called cost of goods sold. And cost of goods sold is going to increase because our expense is increasing. Cost of goods sold is an expense because cost of goods sold is the cost that we pay for the inventory that we actually sold. So it's a direct cost. Now, FOB shipping point. Now the same rules apply. FOB shipping point, the buyer pays for it. So in that situation, on July 10th, the appropriate party pay $100 freight on the sale is going to be no entry. No entry. All right, now we're going to go over to July 11th, paid PJG Inc. for the purchase on July 2nd. So this one is a little bit more complicated. So what I encourage my students to do is always go back and reread and reanalyze the transactions that relate to this company. So let's do that right now. On July 2nd, PJG purchased inventory. So we purchased inventory from PJG Inc. for $5,900, terms 210 and 35 shipping point. So originally we updated our accounts payable by $5,900 and we updated or increased our inventory by the same amount. Freight charges has nothing to do with accounts payable, so you can ignore that because we always pay for freight in cash. So it says paid $130. That's cash. Students always get that confused. It's going to be cash. We paid $130. How else are you going to pay somebody? Cash. So then we return $1,000 of inventory right over here, right? So in reality, we owe them $4,900. So we actually owe them. We owe them pretty much this plus negative 1,000, $4,900. So automatically on July 11th, since we paid them off, we're going to reduce accounts payable by the full $4,900. Okay, but remember now, we have credit terms. If we paid within 10 days, we get a 2% discount. We pay by July 11th, that's within 10 days, so we get a 2% discount. Now that discount is going to be reduced directly into inventory. So we're going to do this by simply taking the negative 4,900 and times it by 2%. So we're times by 0.02, as you can see over here. And that's going to give us negative 9,800. So any discount when you're a buyer gets reduced into inventory because that's reducing your cost of our inventory. Now for cash, in reality, we're not paying the 4,900. We're paying the 4,900 minus the 9,800. So in this case, we're going to do negative 4,900 minus negative 9,800 just to get the difference of the two. And in reality, we're going to be paying out 4,802 because remember, we got that discount now. So let's move forward to July 13th. Some of the inventory sold to this company on July 9th with a sales price of $900 and the cost of $600 was returned because it was a wrong color. It was shipped from shipping point and returned to inventory. Okay, so in this situation, we have a return and we're the seller, right? Remember, when we're the seller, it's a two-part entry, revenue and expense. So let's update the revenue first. In this case, we're going to set up a contra account. So a contra account is attached to a primary account and it simply reduces it. So in this situation, the primary account is going to be sales revenue. And we have two contra accounts that are attached to sales revenue. We have sales returns and allowances. And then we have another contra account is going to be sales discount. So simply put, sales revenue less sales returns and allowances less sales discount is going to give us net sales. All right, so we're going to first decrease accounts receivable by $900 because since they returned the item, they don't owe us that money anymore, $900. Then we're going to set up a new account for sales, returns, and allowances, right over here, right over here. So let's just make it a little bit bigger. All right, perfect. And then we're going to decrease that amount now by that same number. So when I say decrease, so it's going to be a negative number, but remember, since this is a contra account, it has an opposite effect of sales revenue since it reduces it. A negative 900 actually increases this account. This is a contra account. Remember, a contra account reduces a primary account. So that's why that's negative. So technically, the negative 900 increase in sales returns and allowances. So now we've tackled the revenue portion. Now let's tackle the expense portion. So it was the wrong color that was returned. That means we're going to put that back into our inventory, which fully tells us over here. So our inventory in reality is going to increase. So our inventory is going to increase by 600. And then by the same token, our cost of goods sold is going to decrease by 600 because we haven't incurred this expense because we haven't sold that product yet. So we're gonna decrease our cost of goods sold. Now we'll shift FOB shipping point. Once again, ignore this stuff over here. Think about this logically now. Since we made the mistake by shipping the wrong color, it only makes sense for us to pay for transportation. So on July 14th, the appropriate party paid $85 freight on the return. So in this case, we paid $85. Cash is going to be reduced by negative $85. And now we're going to set up a new account called shipping expense. And we're going to increase that account by $85 as well. Next, purchase inventory from this company for $920 cash. Okay, now this isn't on account or there's no credit terms given. It's strictly cash. So July 17th, we're going to decrease cash by $920. And we're going to increase inventory by $920. And FOB destination. Let's go back to this over here. FOB destination, the seller pays for it. So on July 18th, the appropriate party paid $25 freight on the purchase. In this case, for us, is going to be no entry since we didn't pay for it. July 19th, this company paid for the sale on July 9th. So let's go back to this company over here and figure out where the transactions were. So on this day, they owed us $6,800. But then they returned $900 worth. So in reality, they owe us the difference of the $6,800 and the $900. So we're going to first reduce the difference of these two. So $6,800 plus negative $900. We're going to decrease accounts receivable by the $5,900. That's why that's negative, because they're paying off what they owe us. Now, then the next question is, so sorry, let's rewind. This $4,400 and the $600 has to do with the expense portion, which is cost of goods sold and inventory. But we're dealing with accounts receivable because that's what they owe us. So that's why I'm ignoring those numbers. And then the next part is, did they pay us within the discount period? July 9th, 110, 10 days later. Yes, they did. So they get a 1% discount. Now remember, this discount is going to go into sales discount, one of the contract accounts that we've talked about over here, right? So this discount is going to be very easy to calculate. So remember, the sales discount is going to be increased, which is going to be denoted by a negative number. So we're going to take the 5,900 and we're going to times it by the 1%. Remember, terms 1, 10, and 30 mean if they pay within 10 days, they get a 1% discount. No matter what is due within 30 days. When we plug this into our calculator, 1% is going to be 0.01. Sorry, 0.01 right over here. Enter. So then in reality now, we're receiving cash of 5,900 minus negative 59 of actually 5,841. Once again, to recap, the total amount that they actually owe us is 5,900, which is this minus this to get 5,900, and we're reducing accounts receivable by that amount because we're getting rid of the balance that they owe us. Since they paid us within the discount period, we're going to increase sales discount by negative 5,900. To calculate that, we did negative 5,900 times 0.01. And then since in reality they owed 5,900, but they got a $59 discount, they're only going to pay us 5,841. So now that's done for July 19th. Now let's fast forward to July 21st. Received a $120 cash refund from this company for damaged inventory that was returned. It was FOB shipping point. So in this case, we were the buyer originally. So we received a $120 cash refund. So in that case, our cash is going to increase by 120 and our inventory is going to decrease by 120 because the inventory was damaged and it was returned. Now, FOB shipping point, think about this from a logical standpoint. Since the inventory was damaged, we're not going to pay for this. So the appropriate party paid $15 right on the return, July 22nd. That's going to be no entry because that's going to be for the seller. Now, we sold inventory to Hinderling Limited for 7,800 terms 3, 5, and 15. This means if you pay within 5 days, you get a 3% discount, no matter what is due net and 15 days. The cost of the merchandise was 5,600. Shipping terms were FOB shipping points. So the first question is, are we the buyer or the seller? We're the seller because we sold inventory. We didn't purchase inventory, we sold it. So remember, if we're the seller, it's a two-part entry. We have to first record the revenue. Let's do that first. So we're going to increase accounts receivable by 7,800. By the same token, we're going to increase sales by 7,800. So the revenue part is done now. Now we're going to go over to the expense portion. We're going to decrease inventory because remember, we're selling inventory for 5,600. And the exact expense account attached to inventory is going to be cost of goods sold. So we're going to increase cost of goods sold for 5,600. All right, so now it's FOB shipping point. We're the seller. If it's FOB shipping point, we pay for transportation. So the appropriate party paid $130 right on the sale. So July 24th. In this case, we paid it with cash, $130. And then we're going to increase shipping expense by the same amount. So 130. All right, July 27th, we gave an allowance of $600 to Hinderling Limited for inventory that was the wrong model. They agreed to keep it, so no inventory was returned. So even though this is a two-part entry, the expense part is eliminated just because they didn't return it. So they still kept it, but we gave them an allowance. The revenue portion we still have to account for it. So in reality, we gave them an allowance of $600. So our accounts receivable is going to be reduced by $600. And then we're going to increase sales returns and allowances by negative $600. Once again, that's negative because since this is a contra account, a negative number increases it. So sales returns and allowances is actually increasing. Then on July 28th, Hinderling Limited paid for the sale on July 23rd. Let's go back to the transactions that impact this company. We sold inventory for $7,800, but we give $600 allowance. So in reality, they owe us $7,800 plus negative $600, $7,200. So we're going to reduce the accounts receivable by negative $7,200. And now the next question is, did they pay within the discount period? The discount period was 5 days, July 23rd plus 5 days is July 28th. Yes, they did, so they get the discount. Now the discount's going to go into sales discount. So we're going to do 7,200 times 3%. Remember, 3/5 means they get a 3% discount to pay within 5 days. And /50 means no matter what, they have to pay within 15 days. So to get the 3%, we do 0.03 right up here. Enter. So negative 216 is going to be increase on sales discount. Remember, this is a negative because it's a contra account. It reduces sales revenue. Now, in reality, we got less cash. So to calculate that, I'm going to do negative 7,200 minus negative 216 to get a positive cash flow or increase in cash of 6,984. So we're done all the questions now. Let's calculate the ending balances. So I'll do the cash one for you. Then I want you guys to pause and do the rest, and then we could have a look at it. So to do cash, I'm going to do 7,289 plus negative 130 plus negative 4,802 plus negative 85 plus negative 920 plus 5,841 plus 120 plus negative 130 plus 984. So that's how we get the balance. I want you guys to do for the rest of it and then resume the video and take it up. All right, let's go into the other questions below now. Provide the multi-step income statement to the gross profit line. Note, be sure to provide the appropriate title for the partial income statement. So formatting is very important. So let's set that up right now. So remember, in the financial statements, which we'll tackle in this review as well in a later video, it'll be the third video, financial statements. So it's a three-part title: the company name, then we have the statement name, so income statement, but remember it's going to be partial. And then we're going to have for the month ended. So for the month ended July 2021, right? So July 2021 over here. So now they want the income statement up into the gross profit line. So in this case, we're going to start off with sales revenue less sales returns and allowances less sales discount gives us net sales. So let's calculate this. So these balances I'm going to get from this over here directly. So sales revenue is 14,600. And then sales returns and allowances right over here is negative 1,500, and sales discount right over here is going to be negative 275. And then in this case, remember, it should be dollar signs, be this. So then we're going to sum these three together. We're going to do 14,600 plus negative 1,500 plus negative 275 to arrive at 12,825. Then we're going to subtract cost of goods sold, which we also know is from this over here. It's going to be the 9,400. Once again, this should be no dollar sign to arrive at the gross profit. So it's going to be the 12,825 minus 9,400 is the gross profit. We're going to put a dollar sign over here because that's the first number in this column over here as well. And since the gross profit for our example is the final figure, that's going to be a dollar sign with double underlined. Next, they want us to calculate the gross profit ratio. So the gross profit ratio is going to be gross profit divided by net sales. So gross profit, we know it is 3,425. We're going to divide that by 12,825 to arrive at 0.2670 or 26.71%. Would you consider this gross profit margin good? Why or why not? That's hard to say because we have nothing to compare it to, right? Because we have no benchmark, but 26.71% is fairly high. So I would say that's a good, ratio. Why is the gross profit ratio the percentage a better measure than gross profit, the dollar amount, to determine how well the business did for the month? Okay, this is because for a few reasons. One of the main reasons is we could compare the gross profit ratio to different years if these numbers are different considerably. Let's just say 1 year net sales revenue is 5,000 and gross profit is 1,000. Obviously, really, okay, is way better in this given year because gross profit is 3,425 opposed to $1,000. However, if in that year the gross profit ratio is 50%, then that's a much better representation because gross profit tells us how much profit after cost of goods sold we retain to help us pay off our operating expenses. So higher the number, the better. So the gross profit ratio lets us compare two different companies or 2 different years of considerable size on an apple-to-apple basis. So that's why the gross profit ratio is a better measure than gross profit. So on July 13th, some of the inventory sold to this company on July 9th was returned because it was the wrong color. It was shipped fob shipping point. Who paid for the return shipping cost? If you paid, which account did you charge the shipping cost to, and why? Why do you think the shipping terms were fob shipping point instead of fob destination? We kind of already talked about this. So on July 13th, some of the inventory sold to this company. On July 9th was returned because it was the wrong color. So we messed up because we shipped out the wrong product. So in this case, fob shipping point, legal title exchanges hands when this company returned it back to us. So during transportation, it was in our possession. If it's in our possession, we're paying for transportation. Also, logically speaking, since we messed up, we should pay for transportation. So we pay for transportation. If you pay, which account did you charge the shipping cost to and why? We charge it to shipping expense and not inventory because that's the cost of doing business for us. Because since we messed up, we incurred an expense to fix that mistake. That's why that's an expense. It's cost of doing business. And we just want to make it right with our customer. So the shipping terms were fob shipping point and instead of fob destination, because once again, we messed up. It's unfair for us to mess up and make our customer pay for it. Simple as that. As a purchaser, what shipping terms would you prefer, fob shipping point or fob destination? Why, as a purchaser, do you prefer those terms? As a purchaser, we prefer fob destination because simply put, we don't pay for transportation. And if you don't pay for transportation, that means during transportation it's not in our possession. That means we have less liability as well, less risk, because if it's in the possession of the seller, that means if anything happens during transportation, that's on them. That has nothing to do with us. As a seller, what shipping terms would you prefer, fob shipping point or fob destination? Why, as a seller, do you prefer those shipping points? So whatever we talked about in this question is the flip side over here. So as a seller, we prefer fob shipping point because the buyer pays for transportation, and during transportation is in the buyer's possession, meaning something happens during transportation, they're liable for it, not us. So this wraps it up for this question. This is a really, really good question. This question will 100% be on your midterm. Not the exact question, but a very similar type of question that's going to practice the material. So no question is the exact same. That's what's very important, to learn the material, then apply the material to each question. So any differences in the question, you're able to apply the material to it and figure it out. So right now, your goal is to build an accounting language so you can start tackling these questions and succeed at them, right?